So preferred equity, which we sometimes refer to as structured or hybrid equity, has been around for a really long time. But there are a few things in the market today that has increased the buzz. Most notably, the interest rate environment. It's really made the cost of capital in the leverage acquisition context, the calculus has just got much more interesting and opportunistic for the preferred equity investor. At the same time, traditional lenders have really tightened up their underwriting mandates, which means they're loaning to fewer companies, which creates an opportunity for preferred equity to step in and fill that gap. There are some cases where that preferred equity instrument could fill that gap or may be the only option altogether. And then another notable thing really is inherent in preferred equity as a general rule, which is that it's a really flexible instrument. But today, that flexibility has been really useful. For instance, a number of private equity firms are turning to preferred equity to help fill and bridge valuation gaps and get deals done. We're seeing a lot of preferred equity in capital stacks as a result. Secondly, large co-investors who are really essential in the M&A context have become a little bit more shy because of the downturn in M&A. These investors may come to the table, however, if you offer them a preferred equity instrument that can protect them in the downside scenario while also offering them the return profile that they're seeking. And then lastly, there's still a record level of dry powder on the sideline that the investment community really wants to deploy. This has resulted in an uptick in minority investments. So economics are always going to be an important component of any investment opportunity. With preferred equity, we see this by way of the negotiation of the dividend or the return profile, which can be something like a minimum MOIC or an IRR, as compared to a more traditional cash or PIK-paying dividend. The liquidation preference itself is also what makes the preferred equity preferred versus common equity. We also frequently use warrants to fill valuation gaps or to offer a sweetener to existing investors who may be reluctant to approve the preferred equity coming into the cap table. A second consideration relates to governance rights. So these could be anything from a strong right, such as a seat on the board of directors or board of managers, or it could be a board observation right. Or you could build into the instrument itself a super voting mechanism, or a springing or triggering right that comes to life upon the happening of specified events. Liquidity is also going to be a key consideration for traditional private equity, so we spend a lot of time thinking about exit rights. Optional and mandatory redemption features have become common. Drag along and other sale triggers can also be really helpful. Another foundational consideration with respect to preferred equity relates to remedies. The remedies provisions are important because preferred equity is a contractual instrument, so your remedies aren't implied by law. This means that the investor and the issuer need to align to determine how strong and robust they want those features to be. We oftentimes use forced sale or refinancing mechanisms, or we could go even stronger than that with a forced board flip mechanism that gives the investor control of the board. Another remedial provision that we sometimes implement, although less frequently, provides for the conversion of the equity into debt. As I think about traps for the unwary in the context of preferred equity, the first thing that comes to mind relates to tax, accounting, and even rating agency treatment. While these aren't necessarily legal issues per se, the last thing anyone wants is for us to get halfway through drafting definitive documents, only to learn that some of the specified terms that we've heavily negotiated are actually going to result in an adverse tax or accounting treatment. The last trap that I would highlight relates to the fact that preferred equity is still equity. This rears its head in a number of scenarios, including with respect to remedies, fiduciary duties, and other issues. In the context of remedies, it means you can't exercise creditors' rights. You're not a creditor, you don't have a security interest in the underlying assets of the company. In addition, investors are often going to be reluctant to pursue litigation to enforce their instrument because that litigation will be costly and complicated. Additionally, preferred equity is going to be junior to all debt. It's also going to be junior to any equity that sits in lower level subsidiaries of the issuer. In the corporate context, it's also important to remember that the fiduciary duties of the board flow to common equity, not preferred equity. It's another reason why the terms of the underlying instrument are so important. In short, every single preferred equity deal is a little bit different. The drafting is critical and the documents really do matter.